Okay, welcome back to Accounting 101. We're going to be starting off Chapter 6 in this video. I hope you all had a nice spring break. And I can tell you that I graded 60 some or so exams, so I didn't get a break. Chapter 6, again, like the first 5 chapters we've had and the 6, 7 chapters that'll follow, is one of the easiest chapters in the textbook. It deals with merchandise inventory, which we were introduced to in Chapter 5. Chapter 5, we studied the 2 inventory systems, the periodic and the perpetual, and we went over the entries, or we covered the entries about increasing and decreasing inventory. That is, buying inventory from vendors on credit or cash with discounts, and also selling it to our customers for cash or credit with discounts also involved on both sides. A little review: when we sell inventory, we need, using the perpetual system, we need to make 2 entries, one to record the sale and another one to record the decrease in inventory. When we buy inventory, all we do is increase merchandise inventory, and then we have to adjust it for any returns and allowances and discounts that we may take on it. Okay, so Chapter 6 deals again with merchandise inventory. So if you have 2 chapters on merchandise inventory, we can assume that merchandise inventory is a pretty important thing for a mercantile business, and business that sells products versus ones that sells services. Of course, some companies sell both. You sell the copier, and you also sell a service warranty on that copier. Chapter 6 deals with the 4 inventory valuation methodologies, and we'll get to those shortly. I will be sending you out, the PowerPoints, the highlights, and the shell outline like I usually do. And I'll be sending out a form to help you do the exercises, which is something my own invention. Well, maybe not. It follows the one that's in the book, and you can see it's got a whole bunch of columns and rows on it. And don't be intimidated or by the ones in the book. This is identical to it. It looks like a lot, but really, it's the same thing. Between these double lines, you've got a left-hand section, a middle section, and a right-hand section. And if you look at them closely, the columns are the same thing. The date, the units, the cost per unit, total cost. And if you look up the top, you have purchases, cost of goods sold, and the amount on hand. I liken this to, when you look in the cockpit of an airplane, a multi-engine airplane, you wonder why pilots. I saw something over break where, I forget, one of the airlines, the pilots are, the top wages or average wages are going to be $1,000 a year. And you say, hey, look at all those gauges. Those guys are smart, or those girls are pretty darn smart. And what it is, when you see all those gauges, there's a set of gauges for each engine, and sometimes they'll have backup gauges. So you may have 2 sets of gauges for each engine. So a 3 or 4 engine aircraft is going to have 4 to 8 sets of gauges. So if you take it one by one, the ones in the textbook, like I said, I'm going to send this out. I'll advise you to print several copies of this out to help you do the exercises and problems at the end of the chapter. But I'd also advise you to take a couple of these, 4 of them, and work through the ones in the book line by line, because the ones in the examples in the book for the 4 valuation methods will be completed, and you have all that information in it. But if you would take a sheet of paper and cover them and go down one line by one line by one line and build it, it'll take a lot of the mystery and intimidation or scare factor out of it. All right. The chapter starts off with introducing us to some accounting principles that should have been introduced in Chapter 1 or 2, in my opinion, but I didn't write the book. First one is the consistency principle. And this states that businesses should use the same accounting methods and procedures from one year to the next. You'll find in this chapter and in chapter 9 and some of the other chapters that the generally accepted accounting principles often give you multiple ways of recording something. Okay, and it's up to management to decide and pick among those options. But once you have an option, you need to stick to it. And if you don't change, if you do change, it has to be for a bona fide business reason. And there's a whole bunch of stuff you have to do to go through if you do a change. There's a whole chapter in intermediate accounting about accounting for changes in accounting principles. Okay, and it has to be one of the accepted principles, changing from one accepted principle to another. And you have to show the effect of that. But again, that's beyond the scope of this course. And that you have to show the effect of it in order to preserve the comparison from year to year, the consistency, that the financial statements were prepared using the new changes. You got to go back. Depending on what it is, sometimes you just have to do a prior period adjustment. Other times you have to go back and restate the financial statements had the change been made in those years that are being presented along with the current year. Financial statements are presented in what they call comparative financial statements. It shows at a minimum last year and the current year, 2 years side by side. Some companies will show 3 years side by side by side. So whatever you're showing, it has to be prepared using the same rules. If it's a minor change, you just have to show the effect of the change as a prior period adjustment. Okay. Another one they give you here is the disclosure principle. We need to tell the users of the financial statements, people that are going to be relying on them to make decisions, as much information as possible. And that means we're going to tell them what are, usually in the first note of the financial statements, is the summary of significant accounting policies, where we tell them which inventory methodology we're using. We're going to tell them how we depreciate, because when we get to chapter 9, we'll find there are multiple ways to depreciate certain assets, long-term assets. So another one is the materiality concept. This states that we must perform strictly proper accounting only for significant items. This comes into play quite a bit in auditing. A lot of people are under the mistaken belief that accountants strive for accuracy, and we do, but we've already seen a couple times where we have to use an estimate. So when we use an estimate, accuracy cannot be, it can't be 100% accurate. But if we're dealing with $1 million, what materiality is if we're dealing with a $1 million company, who cares if it's off a nickel or a dime or even $1,000? In fact, if you ever saw an annual report of a big corporation, many of them round in hundreds of thousands or round to millions of dollars. Okay. Back when I was a tax auditor, did an audit on AT&T and General Motors. And when I got the federal return, which is part of the Pennsylvania corporate tax return, I looked at it and I said, boy, that's funny. They have 3 digits in the right-hand column, which is the pennies column. And I never saw a corporate tax return with pennies on it, only whole dollars. And then I looked at it and it dawned on me that they were in the billions of dollars, and they had to use that right-hand column that is usually reserved for pennies and cents. They were using that for their thousands column. Okay. So it was a different world. So materiality is, would it make a difference to a informed, rational, reasonable user? Okay. So the next one is the principle of conservatism. And this is often confused. It means use the one which is the optimal one. It's usually, people say, use the one that is most pessimistic. Basically, what conservatism says is we uh, want to guard against, we want to err on the side of caution. Thereby, we want to uh, guard against overstating assets, overstating revenues, understating liabilities, and understating um, expenses. Okay. So if it, like it says here, anticipate no gains, but provide for all possible losses. Okay. You might say that that is a pessimistic way of doing it. Conservative. The reason of conservatism is that if you follow it, we cannot do a disservice to the user by telling that our assets are less than they actually are. The bigger sin would be to tell them that they're higher than they actually are. Same thing with revenues. The opposite is true for liabilities and expenses. The second bullet point there is, if in doubt, record an asset at the lowest possible reasonable amount and a liability at the highest possible reasonable amount. When there is a question, record an expense rather than an asset. When you're faced with the decision between two possible options, you must choose the option that undervalues rather than overvalues your business. The goal of conservatism is to report realistic figures and never overstate assets or net income. And the things I mentioned earlier go hand in hand with, are consistent with that, not overstating assets or net income. Okay. I'm starting to get the hang of, halfway through the semester, I'm getting the hang of using the ebook. I tap the thing to turn the page, and it takes 5 seconds or so. I guess I don't have the patience that I should have or that I had when I was younger. I guess when you get older, time is more critical. But again, I'm used to turning the page in the book and it happening right as I do it. Here you hit the arrow and it takes a while. It's like a delay. And there's no reason for that. If it's electronic, it should happen almost instantaneously. You go on to talk about the control over merchandise inventory. Yeah, you have to watch it. I talked about that when we talked about the perpetual and periodic inventory systems. If I use the analogy of the jewelry store, the Rolex, the Breitlings, the Tag Heuer, the expensive watches are in a display case under lock and key. And when you go in to buy one, they sit you over on the leather or velvet couch and bring you out some champagne and strawberries. And they bring out the watches you're interested in on a silver tray that's got a velvet little towel on it. And the people that want the Timexes, they're hanging on a display tree on top of something over on the other side of the shop. Okay, so we got to ensure the merchandise inventory is not purchased without proper authorization and that we receive what we order. That's exercising control over it. If not, employees, especially people in the purchasing department, could be buying things for themselves, things for their family, things for their neighbors. And people at the loading dock could be, you get 10 cases and they put 8 or 9 in the storeroom and they put 1 or 2 cases in the back of the car or back of the pickup truck. Okay. After the inventory is purchased, the order should be tracked and properly documented when received. How do you know what you're paying for? How do you know if you got everything you ordered? Okay. All these pieces of paper with information about it should be reconciled, should be matched up against one another. Okay. Damaged inventory should be properly recorded and then should either be used, disposed of, or returned to the vendor. And the physical count of inventory should be completed at least once a year to track inventory shrinkages due to theft and damages. And finally, when sales are made, inventory sold should be properly recorded and removed from the inventory records. And this will prevent the company from running out of inventory, often called the stock out. When I worked in retail, we inventoried every 4 weeks, 13 times a year. And our computerized register would keep track of what we sold. And we were allowed to have a ratio of 1 month's worth of sales of any given product. So if we sold 10 products a month, we're able to have at most 10 in stock. And, you set your reorder down when it's down to 3 or 4, whatever. And that's when you would reorder it up to the level to get it up to 10. I always had a trouble with my regional manager about that. Not trouble. I just said, it's an unrealistic goal. And, you want to reduce or minimize the amount of money you have tied up in inventory. I understand that. But I told him the only way that is, and again, your performance evaluation that's one of the goals you were tied to. And I said, it's an impossible goal. And he said, how do you figure that? And I said, the only way you could have that goal is if every customer comes in at regular intervals and buys the exact same thing every time. And every time I order something, I get it. Well, neither of those ever happened. Okay, people change their taste. They buy in different quantities. They try different product. And a lot of times when you order it, you get it, it's back ordered. Data analytics and accounting. There is something called the optimal order quantity. I had an old 5.25 inch, or is it 5.5? No, 3.5, 5.25, 5.25 inch floppy disk. They were actually floppy, and it would have that on it, and you could use it for anything. I actually applied it on a job one time where we were looking at labor. I just looked at labor as a commodity, and I used that software and was able to demonstrate how they could hire 2 or 3 people and save, I forget, $2 or $3 million in overtime costs, and also improved care, because your employees, after an employee works 70, 80 hours a week, they may not be at their sharpest. Okay. In fact, I'll give you a little history on the history of overtime. Overtime was instituted back in the Great Depression, back in 1929 through World War II, 1936, 37, 38 there. Because we had such high unemployment, the government thought it might induce employers to hire more employees, thereby reducing unemployment numbers, by penalizing employers for working people over 40 hours a week, where you'd have to pay time and a half. It would be cheaper to hire a new employee. And then it fizzled out, actually worked out backwards, because they found out they hired new employees. They weren't as well skilled or trained as the current employees, and it was better to pay the current trained employees that are competent at their job time and a half than paying some new person who is not as productive or efficient. So again, good in theory, but bad in practice, which is often the case with things dealing with the government. I once saw a bumper sticker. The government slogan a good government slogan would be, if it ain't broke, fix it till it is. Okay, I think I skipped the page. Let me go back. Okay. How are merchandise inventory costs determined under a perpetual inventory system? Well, it's mathematics, but it's very simple mathematics. Number of inventory units on hand times the cost of those units. Okay. We see there the cost of goods sold is ending inventory. Beginning inventory, cost of goods sold is beginning inventory plus the purchases, additions to it during the year, give you a thing we call total goods available for sale. Subtract out the ending inventory, that's the cost of goods sold. So keep in mind, with the perpetual inventory records, we're keeping track of both the unit and the cost of those units. So they show you in Exhibit 1 a perpetual inventory record. They have dates, quantity purchased, quantity sold, cost per unit, quantity on hand. It's just a simple record tracking the level of inventory, both in units and cost, over the month of August in this case. Okay, so you can take a little bit of time and look at that exhibit and see, again, they're throwing at you August 1st, 5th, 15th, 26th, 30, the 5 dates with different transactions. Not every row has, the same thing in it. The beginning is all the cost per unit and the unit on hand. They don't have the extension column there. 2 units at $350 a unit, $700. They should have another column. They're called the total column. They're just talking about quantity per unit quantity. There's also total quantity or total cost. They purchase some more. It's the same price, no problem there. We're going to see later on in this chapter, when you have purchases at different prices, it gets a little more complicated, but not a whole lot. You just build it like a layer cake. Okay, unless you're using the one method, and then it averages out the weighted average method. But we'll see that shortly. Okay. Now it says measuring inventory costs is easy when prices do not change. Well, guess what? Prices often change, especially during inflationary periods like now. So they show you that and middle of that page, the bottom of that page, I'm sorry. Okay, so here we go. There are 4 inventory valuation methods, all of which are acceptable. But once a business picks one, they have to stay with that unless they have a good reason for changing. And when they change, they have to show the effect of that change. Okay. And they have to they have to disclose the fact that they changed methods of valuing inventory. And what we mentioned earlier about consistency principle. Okay. The 4 methods are the specific identification method, the first in, first out, which is known as its acronym FIFO, F-I-F-O, FIFO. The third is the last in, first out, LIFO, L-I-F-O, and then the weighted average method. Okay, and these things are kind of neat because the names tell you how to do it, how to calculate it, which ones. The big question here when we start filling out these inventory valuation grids is, when you're having a purchase, that's no problem. It tells you how many units and what you paid for them, and then you just bring that over to the purchases would be here, and then you add them to what's on hand. Okay, so if the price doesn't change, you're good. If the price changes, then you have to have 2 layers in the one row. Maybe sometimes you have 3 or 4, depending on how many purchases you made on how many you sold. The middle column is where we keep track of the ones we're selling, the ones we're getting rid of. Here are additions, here are subtractions, and here's the running total on hand. Okay. Again, ask yourself when you're filling these out, the question I would ask myself is, which ones are being sold? And the name of the method tells you which ones are being sold. Okay. Specific identification will tell you specifically which ones are being sold. The ones at this price, the ones at that price, or two at this price and 3 at the other price. And then you do your calculations based on the information they give you. The first in, first out, you calculate it at the name of the method. The first ones you get, the first ones you purchase, are the first ones you sell. So you sell them in order of the order in which they were purchased. Usually, the prices will go up over time. So as you go through time, and you're selling the lower price ones, the earliest ones, the ones you bought earliest first. The third method is the opposite of that. The last ones you purchased are the first ones you sell. And the fourth one is called the weighted average method, and that's kind of neat. It's a little bit more mathematically involved, but it could be a little bit simpler because you only have one number on each row in the grid. You don't have any layers, because whenever you have a purchase at a unit cost different than your current unit cost, you recompute a new unit cost. Okay, and we'll see how that works out. It's not bad at all. Now, of these 4 methods, management gets to pick which method they want to use. It doesn't have to go with how the products actually come in and go out of the store. Think of a natural gas supplier. When you put gas on one end of the pipe, it goes in and it comes out at the consumer's pipe, into their boiler. You would imagine that they would have to use the first in, first out. Well, that's how the gas actually is sold and distributed. But management could use specific identification, depending on what day of the week it comes out, the cost of pumping it out. It could go last in, first out, or it could do a weighted average. And again, we'll look at how each of these gets computed. Exhibit 6.2, they show you what happens when there's a change in cost per unit. And again, we're just looking at the perpetual inventory record here. I don't know if they are telling you what method we're using here now. You can see that on August 5th, the four that were purchased, the price was now $360. So it went up $10 per unit. All right. And they're not calculating the cost of anything in total here. They're just doing it on a per unit basis. Okay. What we want to do, and the first one they give us is the specific identification method, and they're going to give us the information is going to be used in all that they give us here is going to be used in all four methods. Okay. So, the first paragraph they have their specific identification is used when it's a product that can be identified, like automobiles have a VIN number. Okay. Computers here, tablet computers or they're using here would have a serial number on each computer. Okay. The model numbers would all be the same, identical, if they're the same type of tablet computers, but the serial numbers would be different. Now, identify the hardware store where all the nuts and bolts or a candy store, the product you can't distinguish one from the other than the date it was produced or the date you acquired it. Okay, so the information we're starting with is assume that the four tablets sold on August 5th had a cost of $350. One had a cost of, okay, on August 15th, we sold four. They said one came out of the original on-hand inventory of $350 unit, and the other three they sold were at the $360 cost. Okay, so let's see, the August 31st sale, what did we do? We sold 10, and they're telling us here that one had a cost of $350 and 9 had a cost of $380. Now, where's the purchase information here? Well, it would be in that grid. You can see figure 6-3 is pretty much identical to the form I have here. Mine's blank. And like I said, I'll be sending this out to you. So just walking through here, again, don't get intimidated by the thing. Yeah, there's a lot of columns there, but the basic three columns are identical. We're just looking at three of those columns for purchases, three of those columns for the cost of goods sold, and then the last three columns identical to the other two sections, left, middle, and right section, inventory on hand. Okay. So August 1st, the inventory on hand, we have 2 units at $350 for a total of $700. August 5th, there was a purchase of 4 units, and those units cost us $360 a unit, or $1,440. So that was a purchase. So nothing goes into the middle section, three columns, cost of goods sold. That's only when we're selling product. So now, over in the right-hand column, we have 2 layers in that one row called August 5th. The top one, 2 units at $350, is what we had at the beginning of August. That was the amount we had on hand. The lower unit there, 4 units at $360 for a total of $1,440. That is the August 5th purchase. Since it's at a different unit cost, we have to put it on a separate layer to keep track of it. But we can do the total cost over on the right-hand column. We combine the $700 from the beginning of the month with the $1,440 from the August 5th purchase to get a total of $2,140. August 15th, we sold 4 units, and that specifically identified method, they're telling us which ones we sold. We sold one of the $350 unit, and we sold 3 of the ones from the August 5th purchase that were purchased that had a unit cost of $360. So the total cost in that middle section of column under cost of goods sold, we have to do layers. 1 at 350 for a total of 350, 3 at 360 for a total of 1080, combined total of $1,430. Now we have to take those changes and incorporate them in the right-hand section of columns, inventory on hand. So if we had 2 units at 350 from our beginning August 1st inventory, and we sold one of those, we would now only have 1 unit at 350. And if we bought 4 at 360 and sold 3, we have 1 unit at $360. So 350 and 360, 1 each, total of $710. On August 26th, we purchased 12 units at $380. Total cost, $4,560. So look what happens. Nothing happens in those middle 3 columns, cost of goods sold, because we're buying them. We're adding to inventory. We're not selling inventory. The only time you put something in the middle 3 columns under cost of goods sold is when we're selling it. But look what it does over to the inventory on hand section, the last 3 columns on the right-hand side. We now have 3 layers to account for what we have in our inventory. We have 1 unit from the beginning of the month inventory at $350. We have 1 left from the August 5th sale, and that again, those 2 lines repeat themselves from the prior row. 1 unit at 350, 1 unit at 360. And then we have the 12 units at 380. We put that in on the third or the bottom layer there, and then we combine all of them so that we have, it doesn't have it here. Also, when I do it, I put a little slant line in the quarter, like a bowling scorecard, and I keep track. So you'll have 12 units there at 380, 1 at 360, 1 at 350. You have a total of 14 units and a total cost of $5,270. August 31st, we sell 10 units. Specific identification, they tell us which 10 we sold. We sold 1 from the beginning inventory that had a unit cost of $350, and the other 9 come from the last purchase at $380. So you do the extension there. 380 times 9 is $34.20. Combine that with the $350, and you have a total cost of those 10 units being sold of $3,770. So now we have to see what the impact of that sale was on the previous row. Well, we had 1 at 350 and we sold 1 at 350, so the 350 units are gone. We have 1 left at 360, and of the 12 we paid $380 for, we sold 9 of them, so we have 3 left at $380. And that's where you get the last row in the last right-hand section under inventory on hand. Now, if you look at that bottom row, they have a total for the quantity of laptop, tablet, computer, and they have a total for the cost of those purchases. In the middle section, cost of goods sold, they have the total units sold, 14 units, and they have the total cost of goods sold by adding the $1,430 and the $3,770. And in the last section, all that does is a summary of that last row. $1,500, 4 units, 1 at 360 and 3 at 380. We specifically identified which ones were being sold. Again, the name of the method of the inventory valuation method will tell you which ones are being sold. Like I said, we'll send this out and print out a whole bunch of these, and I would go over these exhibits so you could see how they work line by line. Because when you look at that chart in the book, it's like getting hit with a whole tractor trailer load of stuff, where you take it apart piece by piece, and you can follow it easier, and it makes more sense. You essentially build it as the book has it built. I went forward too far, and now I went back too far. Inventory calculations, first in, first out. Okay, FIFO. The cost of goods sold is based on the oldest purchases. That is, the units purchased first are assumed to be the ones being sold first. So we have the same information throughout all four examples here. So again, Exhibit 6.4, we're going to have the same purchases and the same sales, but now we're going to identify the ones being sold, not specifically, but we're going to say the first ones we had are the first ones we sold. So once again, we start August 1st with the amount on hand of 2 units at $350 a unit for a total of $700. August 5th, we have 4 units purchased at $360 for a total of $1,440. Same as before. The top 2 rows are going to be the same in all these examples, all except the average weighted cost example. So we have to have the 2 layers there, 2 from the beginning inventory that have a unit cost of $350 and 4 from the August 5th purchase at $360, and we have a total of $2,140. Now, on August 15th, again, we sell 4 units, but which 4 are we selling? The first ones in are the first ones out. So we have to account for the sale of 4 units. So the earliest ones were the ones we had at $350 a unit cost. So those 2 go out. We sold 4. We have to account for 2 more. So 2 more, and they come from the August 5th purchase at $360. So on August 15th, the 4 units we sold are 2 from the beginning inventory at $350 and 2 from the purchase of August 5th at $360 for a total of $1,420. And what does that do to our merchandise inventory on hand? Well, the 2 from the beginning inventory are now sold. And from the 4 of the August 5th purchase, 2 were sold. We have 2 from that purchase left at $360. August 26th, we added 12 units at $380 each. So now we have 2 layers over in the right-hand most column in the inventory on hand, the 3 columns there. And we have 2 units at $360 for a total of $720. We have 12 units at $380 for a total of $4,560. Those 2 combined are $5,280. So we have 14 units at a total cost of $5,280. And then we sold 10 units on August 31st. Which 10 did we sell? Well, the earliest ones purchased would be the 2 at $360. So they're all accounted for. We sold 10. We just accounted for 2. We have to account for 8 more units being sold. They come out of the 12 purchased on the 26th at $380. So you have 2 at $360, 8 at $380. You do the extensions there, combine them, get a total cost of $3,760. And that leaves us with the 4 units from the August 26th purchase that were unit costs of $380. They explain all that in the words below. And then they show you the journal entries and all things. The journal entries are the same as we've always been doing. It's just how we're going to determine the cost of goods sold now. Again, just keep asking yourself, whenever you have a sale, which ones are being sold. Do that and you can't go wrong. Okay, it's getting a little patient here. And last in, first out, the third method. Again, the information they give us is exactly the same for the purchases and the sales and the dates and the amounts. Yep. Oh, come on. Yeah, patience just ran out. Oh, why can't this? Okay, Exhibit 6.5, last in, first out, LIFO. What I always suggest you do is up in the upper left-hand corner, write the name of the method you're doing. And then you can look up there and say, specific ID, first in, first out, last in, first out, weighted average cost. All right, again, we're beginning the month of August with 2 units that we paid $350 for. And August 5th, we buy 4 units at $360 a unit. So those two rows are identical to the first two methods, specific identification and uh, FIFO. Now, where it changes is when we have a sale, August 15th. Which ones are we selling? Well, what method is it here? LIFO, last in, first out. So we're selling 4 units. They're going to come from the last units we purchased, which were the units that we paid $380 for. Okay? So now, um, okay, so the 4 units we're selling on August 15th are the 4 we bought on August 5th, which leaves us our inventory on hand of the 2 units we had at the beginning of August that cost us $350. August 26th, we buy 12 more units. This time the price per unit is $380. Price per unit cost is same, interchangeable, for a total of $4,560. Middle section, cost of goods sold, is not affected because this is a purchase. We're adding to inventory. So we just bring that layer over to the right-hand 3 columns, inventory on hand, and we put it down as the 2 units from our beginning inventory of $350, our 12 units of this purchase at $380. Do the extension, $745.60 for a total of $5,260. And now on August 31st, we sell 10. Ask ourselves, which 10 did we sell? Well, what method are we using? The last in, first out. So the last 10 we got in are the first 10 we're going to sell. And since the last ones we got in were a order of 12 units, all 10 of them come out at that $380 price. So you got 10 units at $380. Let me see, that's $3,800. And that leaves us our 2 units at the beginning of month price of $350 a unit. And since we bought 12 on August 26th and we sold 10 of them, we have 2 left that cost us $380. So do the extension there, $760 plus the $700 from the beginning, total of $1,460. Now you recap it on the bottom line there. Total purchases, 16 units, total cost $6,000. That'll be the same in all cases. The purchases do not change. What changes is the cost of goods sold, and because of that, there's also going to be a change in the inventory on hand, dollar-wise, not unit-wise. Cost of goods sold, 14 units sold with the cost of $5,240. 4 units left on hand with the cost of $1,460. You can look back at the earlier ones, the specific identification and the first in, first out, and you'll see that the total units purchased and total cost purchased is identical. Cost of goods sold, the units are the same, but the cost is different. Inventory on hand, units are the same, but the cost is different because we're doing a different way of costing it. Finally, the weighted average cost method. I give you a highlight there that LIFO is not permitted under IFRS. It's also not permitted for tax purposes. And I show you the journal entries there. And what I said, that little bubble underneath the journal entries is what I alluded to before. It doesn't matter how this stuff actually flows through the business. Again, if you're dealing with perishable goods like baked goods or produce or meat, you'd hope to. I mean, yeah, I would think everybody that grocery shops does what my wife and I do. You're picking up the milk, you look at the date, sell by, and you get the one with the oldest date in the future because, that's the freshest milk. Look at the dates. That bubble there. Think about going to the grocery store to buy a gallon of milk. Which gallon is in front of the milk cooler? The older milk or the newer milk? Yeah, because they stock it from the back. The older milk is in front. That's FIFO, first in, first out. Now visualize reaching all the way back of the cooler to get the newer milk, fresher milk. That's LIFO. It's important to understand that although this image represents the physical flow of goods, an inventory costing system may or may not match the actual physical flow. Yeah, it doesn't have to. Management has the discretion to pick which method they want. They just have to stick with it unless they have a good reason to change, and then they have to disclose the effect of the change. The costing system is only an assumption about how cash flows. Costs flow. The inventory does not have to actually be sold in the LIFO or FIFO manner, or even the specific ID manner, or the weighted average cost. Hey, boy, that takes a long time to turn pages. Okay, now the weighted average cost method. Okay, sometimes it's called the moving average cost. This is kind of neat. What it does is whenever you have a purchase at a cost different, higher or lower than the current unit cost, you have to compute a new unit cost. And that's very easy to do. If you look at Exhibit 6-6, you'll notice it looks different from the other ones in the fact that there are no layers in the cost of goods sold section, no layers in the rows under the inventory on hand method. So it's a little bit simpler in that aspect. Everything is one entry per row. You start off with the beginning inventory, 2 units at $350 for a total cost of $700. You have 4 units purchased on August 5th at $360. Oh, ding, 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 red lights flashing. We now have 2 different units. We have a purchase at a different unit cost than what we have on hand. So we have to do a new calculation of unit cost. So the way you do this is take the units from the purchases, add them to the units of the inventory on hand. You have 2 units on hand and you're buying 4 more, so that gives you 6 units. Then you go to the third column, the total cost, and you had $700 in the August 1 inventory, the 2 units at $350. You have $1,440 now total cost of the purchase of those 4 units at $360. So you add the $1,440 and the $700 from the previous row together, and that gives you the $2,140 total cost. What you had on August 1st and the cost of the 4 units you bought on August 5th. Combine those 2 amounts, $2,140, divide that, that's the new total cost, divide that by the new number of units, 6 units, the 2 you had in inventory, the 4 you purchased. So the $2,140 new total cost divided by the new total units, 6 units, gives you a new unit cost of $356 time in this course where we're going to, okay? And again, use the conventional rounding if you have something that comes out to a third decimal, 0.5 round up, under 0.5 round down. August 15th, we sold 4 units. Okay, what's the unit cost? Well, there's only 1 unit cost now because it's a weighted average. So 356.67 times 4 gives us the $1,427, leaves us with 2 units at that same unit cost, or a total cost of $713. They might be rounding here a little bit, I don't know. August 26th, we buy 12 more units at $380. Okay, red light flashing, siren going off. We have a purchase at a unit cost higher than our current unit cost. So we have to compute a new unit cost. So again, add the units being purchased to the units on hand. Units on hand were 2, 12 units purchased gives us a new unit total of 14 units. Then part 2, step 1, compute the new number of units. Step 2, compute the new total cost of the units you had on hand combined with the new purchase, and that is the $5,273. Divide the new purchase total cost by the new units, and that'll give you the new unit cost of $376.64. Okay. They show you the computation to the right hand, farthest right side of that total cost under the inventory on hand columns. Again, you compute everything, or you summarize everything with the total. Again, 16 units, it's $6,000. Cost of goods sold is going to be the same number of units, 14 units, but now the total cost is different because we have a different unit cost. And again, inventory on hand, 4 units again, but now the cost is different. Okay. As I said there, as previously noted, after each purchase, Smart Touch Learning computes a new weighted average cost per unit, and they show you how to do that. Yeah. With the weighted, weighted average cost on rounding errors can occur. However, this is not the case in this example, okay? And again, we're talking about the materiality concept that we saw at the beginning of the chapter. If you're off a penny here or there, no big deal, okay? The impact of these inventory valuation things affect both the income statement through the cost of goods sold and the balance sheet with the ending inventory number. You can see from these 4 different exhibits we just went through for the specific identification method, first in, first out method, last in, first out method, and the weighted average method. We got different numbers for the cost of goods sold. We got different numbers for the inventory on hand at the end of the month. That's going to be your balance sheet number. Cost of goods sold is going to be your income statement number. So you're going to have different financial statements depending on what method they use. The specific identification is what it is. First in, first out is going to give you the oldest cost of a purchase is in the cost of goods sold and the most recent cost on your balance sheet, ending inventory. Last in, first out is going to give you the most recent cost of goods sold on the income statement and the oldest number for your balance sheet inventory amount. Over decades, that number can somewhat be distorted under last in, first out. Now, what does management want to do? They want to make the higher expenses, which would be the most, in most cases, the most recent purchases, or do they want the higher cost of the most recent purchases in the ending inventory to make the balance sheet look stronger? Again, management has those reasons plus other reasons for choosing which method they use. But again, it doesn't have to follow the actual physical flow of how the goods move from the stockroom through the store and out the front door with the customer. And again, these are assumptions about the way the cash flows in the inventory. Okay, there's a couple things, and then I think we're done with the chapter. Yeah, what I just said, using how our financial statements affected using different inventory costing methods, and I just summarized that for you. The book also summarizes it, and they do a table for it. And again, it depends on whether you're in inflationary times or not, and stability, and LIFO and FIFO are opposite. They're going to have the peaks and troughs, being opposite with the income statement, cost of goods sold, and the ending inventory balance sheet. The weighted average sort of smooths it out. Okay. Turn the page here with electronic textbook, and they show you the impact of that on the balance sheet and the income statement. And if Exhibit 6.9 does a nice summary of that. What happens when the inventory costs are rising, when the prices are declining, and how each method impacts each income statement and balance sheet. Okay. And two more things we have here is the inventory turnover and the lower of cost or market rule. The lower of cost or market rule is a topic for intermediate accounting. You just have to know that it exists, and what it states, it's an offshoot of the conservatism principle. If inventory, if the fair market value of inventory falls below the cost that we paid for that inventory, we're going to record it at the lower of its fair value, lower of cost or market value being, what it's worth. An example I could think of off the top of my head, it would be the iPhone. When they come out with the new iPhone, the ones in the store, the old ones, I don't know if they're up to 14, 15, whatever now. As soon as they come out with the new one, whatever is left in the stores is obsolete and the price goes way down. They can hardly give them away. So that inventory is worth less than what the cost of that inventory is. So they write it down with a, going to cost of goods sold, an adjustment. Write down the inventory, write up cost of goods sold. And there's a really not too complicated, but there's about 4 or 5 factors that go into it. There's a floor and a ceiling for the lower of cost or market. Again, that's a intermediate accounting topic. You just have to know that it exists, and they got to use it the lower again, so you don't overstate the assets. If Apple stores did not write them down to the lower of cost or market, they would have inventory on their shelves that is obsolete, yet they're carrying it at higher cost, the cost they paid for it, and other than the cost they could realize by selling it. So the market value is below its cost. You value it at its market value if it's lower. Here they show you the entry there, debit cost of goods sold, credit to the merchandise inventory asset account, and that's how you write it down. And there is a note, statement of significant accounting policies, merchandise inventory are at the value of lower cost of market. Cost is determined using FIFO method. So they have to disclose that. So because if you have one company, let's say you have Walmart and Target, and they use different inventory methods, well, you have to, the decision makers, people that are relying on financial statements, they want to know that, so it enhances the comparability. You say, well, this company has $50 million of inventory, and this one only has 40. Oh yeah, but they use different methods. Well, then you can factor that into your decision a little bit, and that's why we have to inform the users of what method is being used. Hey, give you a little ditty there on Dick's Sporting Goods, which was started up in Binghamton, New York, but is now headquartered in Pittsburgh, Pennsylvania, thanks to Governor Rendell. Gave them a nice incentive to relocate corporate headquarters. What are the effects? Again, if you make a mistake, it will self-balance, but it'll take it 2 or 3 years to self-balance. You can read over that. And if you make a mistake, you correct a mistake. If not, you're going to have overstatements and understatements, but they're going to cancel themselves out over 2 years. Three years. Okay. Read that thing about ethics. The physical inventory and knows the importance of business and what you should do, and do the right thing. What do you think? Last, like our authors are in the custom of doing, they introduce some new financial ratios to us. The day sales in inventory and the inventory turnover ratio. These are measures of the same thing. just in different measurements. Um, Come on. Inventory turnover is the cost of goods sold divided by the average merchandise inventory. Average merchandise inventory is defined as the beginning of the year inventory plus the end of year inventory divided by 2. Uh, you can, if you're a more seasonal type business, you could take your 3 or 4 seasons and divide by 3 or 4, or you could do it on a monthly basis, depending on how much math you want to do and how much you like to do math. Okay, a high rate of turnover indicates that the merchandise is moving quickly. A low rate indicates that it's not moving so quickly. So again, the higher it is, the better it is for the business. Okay. Now, the thing is with inventory, a retailer, you want to balance. It's a balancing act, walking a tightrope. You want to have just the amount. Earlier I talked about I had a old floppy disk about the optimum order quantity. If you have too much inventory on hand, what's happening? It's sitting on the shelves collecting dust. You have a lot of money tied up and not getting a good return on that money. Too little inventory, and customers come in, can't find what they want, and they go somewhere else and buy it. So you want to strike that happy balance between having just the right amount, what they call the optimum amount of inventory. That's a management course, really not an accounting course. But this is one way you can look at it, see how often your inventory turns over. The inventory turnover tells you how many times a year its average inventory is turning over. Okay, like I said, where I work, we were looking for a 13. I know 13 times a year, once every 24 weeks, every 28 days. Okay, now, come on. The days sales in inventory is based on the inventory turnover ratio because it uses it in the denominator, and it puts 365 days in the numerator. So the inventory turnover tells us how fast it's turning over, how many times a year average inventory is being sold. The day sales in inventory, since it uses inventory turnover in its computation, tells us how quickly it's turning over, but instead of how many times a year, it tells us how many days. Okay. If you take 3.48 times 105 days, you should get 365. In fact, I have my handy dandy calculator here, and I'll see what that comes out to. 3.48, I don't know if that's a rounded number or not, times 105, 365.4 days. Yeah. So yeah, they rounded it up a little bit there because there's only 365 days in a year. Again, a measure the same thing, but it's like using, the speed limit is 55 miles an hour or 80 kilometers an hour. It's the same thing. It's just a different measurement. We used to take my wife down to Florida to visit her to see her mother, who passed away a few years ago. I played golf all day, and my wife would always, you can't drive the car unless it's got more than half a tank of gas. And again, you're on the interstate, and I know what states there was lower taxes on the gas and how far I could go. And every hour, how much gas you got left, and it was like a game. And I'd tell her, quarter of a tank. Quarter of a tank's 5 gallons. Tank. Then I started telling her in time. Well, we've got quarter of a tank left, 5 gallons, 20. We got an hour and a half left, an hour and a half of fuel left. And then I would tell her we have 100 miles left. So, there's 4 or 5 different ways I can tell her how much gas we have left in the tank. That's what this is. Measuring how quickly inventory turns over. One is telling us how many times a year. The other one is telling us how many days. The Wall Street Journal used to publish, I forget on what day of the week, it would publish the inventory of the major auto manufacturers, Ford, General Motors, and Chrysler Corp, when it existed before it got bought out by Mercedes and then sold off to Fiat. And I would watch that if I was in the market for buying a car, because when they have a high level of inventory is when you're going to get, that means the inventory is not selling, and that's when you're most likely to get the best deal. So again, information can be a powerful thing, and you can use it to your advantage. Okay, that concludes my lecture discussion of Chapter 6, and just a little so too bad. And I'll be sending out that form as well as the shell highlights and PowerPoints after the break is over. I guess the break officially is not over until Monday, 8 a.m. Monday, March 13th. So I don't know if I'll send these out. It's late Sunday night. It's dark out, and we turn the clock, so you can say, hey, it's 10:30 at night. So I don't know if I'll sell. No, I'll send them out tomorrow morning. So you should be getting these Monday morning.